Will APRA increase interest rates for property investors? We know APRA has already tapped its foot on the brake to try and slow the housing market down, but it hasn't really pulled on the handbrake, and it's likely that as our property values keep rising, APRA is going to interfere further. So today we're going to have a chat about a number of other measures they could introduce, including raising interest rates for property investors. Dr. Andrew Wilson is going to explain why the justification for APRA's actions are paper thin, plus lots more. So if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so you can be informed each time a new show comes out. The combined value of all residential real estate in Australia is now over $9 trillion, but that's up from $8 trillion just 5 months ago. This time around, though, unlike previous booms, it's been driven by owner-occupiers, not by investors. In my mind, there are two factors that have driven the current property boom. There's no doubt the lower interest rates made it easier to afford a home. If you think about it, if you can afford to pay $28,000 a year for your mortgage, the banks will lend you $1 million. But it's more than that. The pandemic has reminded us how important our homes are. Not only do we sleep there, but we eat there, we watch TV, we work out there, and many of us now work from home. No wonder the market's become so emotional about where we live, not just our home, but also our neighbourhood. But the regulators, they also seem to have become emotional. They're worried, and the Australian Prudential Regulation Authority, APRA, the lending regulator, announced changes to the lending rule for our banks. It was only a week ago, but it's old news now. They told banks and other authorised lenders that from November, borrowers are going to need to be able to make repayments at least 3% higher than the loan product rate to receive a loan. If, for example, you apply for a mortgage with an interest rate of 2.5%, the bank must now assess that you're going to be able to make your repayments with interest rates at 5.5%, rather than the previous serviceability assumption of 5%. APRA's decision reflects their growing concern that high-debt home loans amongst new borrowers could lead to financial instability. But as you're going to hear in my chat today with Dr. Andrew Wilson, Australia's leading housing economist, the justification for this intervention is paper thin, once again. And you'll hear Andrew explain a number of the other potential macro-prudential controls that APRA might introduce, and one of them could be higher interest rates for property investors. Of course, APRA is again justifying interfering in the housing market on the fear of higher interest rates, despite the Reserve Bank clearly and consistently pronouncing that rates are not going to rise until 2024. And for interest rates to rise 3% above the current market rates means APRA would have to have 12 of those regular 0.25% interest rates hikes. Now that's really unlikely. There's lots more property news to discuss this week, so I look forward to my chat with Dr. Andrew Wilson of My Housing Market in this week's Property Insider Chat. Hi, Andrew.
Yes, hello, Michael. I'm sorry, but I couldn't help having a little bit of a smile there at some of your points in regard to particularly where interest rates go, and not just the fact that it's 3 years down the track that's predicted by the Reserve Bank to be the very earliest we'll see higher rates. But as you said, to cover that buffer that APRA have placed on repayments, that we'd have to have 12 rises following that. And I mean, we can sort of firstly discuss the really nonsensical view of the world in terms of interest rate direction in regard to these buffers. Firstly, of course, we haven't had an official interest rate increase in 10 years. So it's 10 years since we've actually had to raise interest rates. And then it's going to be another 3 years till we perhaps raise interest rates. So that's 13 years. And of course, to get to that point, we're going to have rip-roaring inflation and rip-roaring incomes growth, not just inflation, but we also have to have correlating incomes growth, as we did back in 2011 when we were in the middle of a rip-roaring mining boom. And we did have rip-roaring inflation and rip-roaring incomes growth. And of course, that was why the Reserve Bank increased interest rates then. I think that we're about as far away as we possibly could be from those macroeconomic circumstances that increased rates 10 years ago. Of course, where we had the bogey of potential higher interest rates thrown at us if you're a mortgage holder or looking to be a mortgage holder to justify having to pay more for your mortgage now. I'm not surprised APRA acted. I mean, we've been discussing this for a few weeks now, Michael. We've been making the case quite strongly that they shouldn't act. Perhaps we were whistling in the wind a little bit, knowing that they've got form, APRA. They've done this before. under the same pretext, of course, back in 2015, they actually did it a little differently then. They directed banks to reduce lending volumes to investors. That meant higher interest rates for investors. And again, the pretext was, or the risk for them to do this was that they believed interest rates were going to rise and that would create risks for the housing market and the economy and the banking sector, particularly from investors who tended to be more highly geared. Of course, the reality back in 2015 was that the Reserve Bank was consistently saying then that the next move in interest rates would be up. So it's a lot different to now, and it was coming imminently. Of course, the Reserve Bank were completely wrong in their forecasts and their predictions at that time. So I guess APRA could have used the cover of the Reserve Bank to justify intervention in the housing markets back in 2015. They can't use that cover now, Michael, as we've just discussed, because the Reserve Bank has clearly and consistently said that it doesn't have any intention of raising interest rates given current circumstances until 2024. But nonetheless, APRA have acted. It's almost as though they are a moth to the, I guess, the media flame that continues to want to talk up this potential. And of course, they've done that. Now, there's no doubt that when we look at the other justification, and that's the sense that APRA has of mortgage holders' debt, that debt level is rising. My measure of housing affordability, which measures the proportion of the average income that the average mortgage holder is paying as a repayment, has certainly deteriorated. In other words, that proportion is increasing. And of course, we know that because prices are rising, and that means that you have to borrow more to stay in the market. And without higher incomes or without a lower interest rate, it means that that proportion continues to increase. And as that happens, house prices start to ease. And we've seen that house prices were easing organically as affordability declined. It wasn't good enough for APRA. They blinked, right? Because they decided, no, they couldn't take a chance that the falling affordability would not have an impact on housing markets, that it wouldn't just find its own floor, and then we'd be into a much more stable future once we'd caught up with where we've been trying to catch up with over the last 3 or 4 years as a result of all those interruptions. But the other point is, Michael, that if the Reserve Bank is telling us that rates won't rise till 2024, and APRA are saying, well, we're worried about higher interest rates, even though it's not imminent, clearly, according to those that set interest rates, the Reserve Bank, even if rates did rise in 2024, Michael, in that 3-year period, of course, we would have had some incomes growth. So those mortgage holders would have had an increase in their income, which would have improved their debt levels. Of course, they would have repaid a proportion of their loan for a start. So they would have a smaller loan having repaid it. And the other point is that their property values would have increased as well. Perhaps not at the rate of this year, but I believe that property values will continue to increase, given that we have an emerging shortage of property in this country, that property values will continue to increase over the next 3 years. And that means, of course, that the household wealth measure will have increased, that household wealth will be higher because of higher asset values. So higher incomes, lower debt, higher asset values, it's all good news to me, mate. And I don't know why we're trying to worry that this is a problem now to the point where we have to restrict lending. But I think that, and we'll sort of discuss this shortly, Michael, that the problem isn't so much the actions that APRA have taken now, it's what's to come. Because I think once you've entered it into the field of macro-prudential control, Michael, if it doesn't succeed in the short term, you have no choice but to continue to act, or the justification of your actions in the first place look paper thin.
Well, I agree with you. It really looks like they're just applying the brakes at the moment rather than slamming them on. This isn't really going to slow the market down. So it suggests that there are going to be other macroprudential controls coming in. But Andrew, you made a good point about consumer confidence and the wealth effect, as we're working our way through the difficulties of COVID and the extra borrowings the government has taken on and the businesses that are having a hard time, we need the economy to get kick-started quickly. And one of the best ways of doing that is to increase consumer confidence and make people feel wealthy, that the value of their homes are rising, the wealth effect. What APRA is doing is going to almost do the opposite.
And look, the other point is that APRA said that they're quite confident, and this again is sort of counterintuitive to what they were saying, is that they said that the economy, in their opinion, was primed for a rebound post-lockdown, that they were quite confident that the economy would improve once we moved out of lockdowns. And yet they're saying that they're not happy about the general position of the capacity of those mortgagees to repay debt. And yet then they're saying, but the economy is going to be improving. So 6 of one, half a dozen of the other to justify their positions. I mean, we've got to understand that APRA, the financial regulator for the big four banks, they are part of the system of strong market power that we allow our banking system to have, because we do want it to be risk-free, or as risk-free as it can be. But at the end of the day, you can overdo risk management, Michael, and it's akin to sort of throwing the baby out with the bathwater at one stage. And the point is, if you have such significant market power in the financial sector, as the big banks do have, and that's exercised with the similar market power that APRA has in managing risk, it can cause significant repercussions if you overmanage risk. We've seen that. I don't have to speculate on that. In 2015, because they were predicting higher interest rates, they got that wrong, clearly wrong. We saw a collapse in investor activity. We also saw a collapse in apartment construction. Now, investor activity has only just started to rebound now, Michael, and we've also started to see a small glimmer of a revival in apartment construction, but it is coming from a very, very low level. And part of the consequences of those actions, that is record low investors and a collapse in the apartment market, is we're now starting to see rents skyrocketing in most capital city markets because we've run out of rental properties. House rents are going through the roof in most markets because of that shortage of investor activity and the shortage of construction, which in apartments, we have had a boom in house construction over the last 12 months as a result of the home builder initiative, but that's finished. And that's basically been directed at outer suburban new homes, fringe dwelling. Now, not everybody can or wants to live on the fringe of our capital cities. And this, again, plays its way into housing shortages, which means eventually higher prices and higher rents. So the market power that APRA exercises through the market power that the big banks have can have these repercussions. And APRA says, well, we don't care because we're about managing the risk profile of the banks. Well, that's fair enough. But you might not care, but consumers care, and the government should care how consumers are exposed to this. And I think we need to have a very serious conversation about the nature of the market power of the big banks and APRA, how they exercise that market power. And as I said, I think, Michael, we are just at the beginning of this macro-prudential roller coaster, because the big point is this, Michael. We're already seeing this. Thankfully, we're moving out of lockdown. We've had restrictions to property transactions because of lockdowns. It has halted the boom marginally, but the boom is back big time. Massive results on the weekend out of our auction markets. I'm tracking a flood of new listings coming into the market now. We are going to revisit the high prices growth I believe we had in the middle of the year. So what does APRA do then? I mean, it's just the very worst time. You know, if they could have anticipated that there would be another wave of revitalisation in our housing markets, which would cause higher prices and higher debt levels, logically, and that they should wait until at least that rebound had satisfied itself in the shorter term before acting. Now, they're going to have to be asked the question, clearly, well, you acted back at the end of September, given circumstances. Now you're going to have to act again because circumstances are now, according to your measures, worse in terms of debt levels. And what does that mean? It won't mean because it's cloud cuckoo land to increase that buffer. Logic will tell you that people are just going to roll their eyes to have an interest rate buffer which we haven't seen that level of interest rate for 11 years, and we have no chance of seeing that level of interest rate anytime soon. Just ask the Reserve Bank. So they're going to have to use another mechanism, Michael, and they have said that they will use other mechanisms. And that means actually pushing up interest rates. That means they will act, I believe, if we get which I think is logical, the surge in activity and higher prices again through middle and late spring, they will be seriously contemplating, I believe, increasing interest rates and maybe to particular groups, such as investors. But this will again just cause that roller coaster outcome that we had last time. So they're really in a corner, I believe, Michael, and they really just should have left well enough alone, particularly at this point of the cycle, given we're coming out of lockdown and we will see a revival in market activity from a high base. And we're already seeing that last weekend.
Well, Andrew, as we've explained over the last couple of weeks, sure, property values have increased by around 20% this year, but they were flat since the previous peak in 2017. So the market's really just playing catch up, meaning over the cycle, average capital growth hasn't been exceptional. And you've brought it up the point over and over again. The safest way to slow down rising house prices is to allow house prices to keep rising. Eventually, affordability is going to kick in. And you've noted that the market is working its way through the cycle as the lack of affordability naturally slows prices down over the next couple of months. So what do you think the next steps are going to be?
Well, it's going to be a very difficult decision, perhaps, for APRA, because they are going to be confronted with a strong market through to the end of the year, I believe. So whether they say, well, we've done enough, we're just going to let the market do its thing, okay, well, maybe they should do that. But the point is that they will be obviously hounded by the media and those attention seekers looking for cheap headlines about, well, it's getting worse. What are you going to do? Look at those debt levels, right? They're still rising because prices are rising and incomes aren't rising as fast as prices, yada, yada, yada. And the pressure will be on them. And there's no direction from Treasury or from the government. They are, as I guess, perplexed in terms of what they should do and how the market is operating, that they're quite happy, I guess, to leave APRA to carry the can. We're already seeing massive surge in listings from Melbourne, and sales, just after they eased the property inspection restrictions, Michael. That market's really back in town, and Sydney's a massive market now. And the other point is that we're seeing still very strong clearance rates from higher volumes. So there's still more buyers and sellers out there in the marketplace. And of course, that fundamentally means higher prices. And as I said, look, APRA increased interest rates to investors, as I mentioned, back in 2015. Even when we saw investor activity falling sharply, and it has fallen sharply since 2017, rising again, there's been no discount for investors. They still pay the same high interest rates. The relationship between the owner-occupier interest rate and the investor interest rate is exactly the same now. So all that risk management did, even if in the short term it certainly felt it was going to be justified because of the fallacious predictions of higher interest rates, it didn't occur. And yet investors have had to continue to pay higher interest rates, Michael. And of course, I know the banks are pretty upset about having to get higher interest rates from 30% of the market. And of course, they'll be really upset if they have to charge higher interest rates because of APRA's actions going forward, if APRA decide to increase interest rates as their next act to control the housing market.
Well, Andrew, there is a little loophole for potential borrowers because, interestingly, the 3% buffer doesn't apply to non-bank lenders.
That's right.
APRA probably will encourage them to do the same later this year. So there may be a short-term loophole. But just recently, the Reserve Bank ran its semi-annual financial stability review, and they said the banking system's generally sound. They said it's well capitalised. Sure, they suggested a debt-fueled surge in house prices needs to be watched, but they didn't seem too concerned about what's happening at the moment.
Look, a couple of points, Michael. Firstly, the way to ensure the longer-term risk version of banks is what I thought they were doing anyway, and that is for APRA to mandate that banks do not lend more than 80% of the valuation of a property. So you have to have a 20% deposit. And also that they mandate that you cannot repay more than 25% of your income in your new loan. So if you mandate that, those boundaries are strict enough to handle risk as it has been traditionally and in the long term historically. And I think any sense of overborrowing, then the fact is that banks would not be allowed consumers to overborrow because they would be the guidelines under which all lending occurred. So that's the first point that should logically occur. Now, the other point in regard to what will drive more activity is, hey, Michael, if you're a savvy investor or a savvy home buyer, you're going to join the dots and say, well, it's only going to become tougher for lending over the foreseeable future because APRA have acted now and are likely to act again. So, hey, wouldn't it make sense if I got in earlier to make sure I avoided a higher interest rate or certainly more restrictive lending conditions in the foreseeable future? Again, that's just working against what APRA are trying to avoid. As I said, they've blinked and now they've got to wear it.
Okay, you mentioned a couple of times about the markets doing well, and clearly they have as we're now working our way out of lockdown. The auction markets started the spring season really strongly, didn't they?
Well, they did, Michael. It's again reinforcing what I said regarding the end of lockdown and particularly the end of those property inspection restrictions in Melbourne. Those markets have roared back. We had some very strong results again on the weekend. Of course, auction numbers rose strongly in Sydney because the weekend before was the long weekend. So we had a bounce back in Sydney in auction numbers, but another very big result for the Sydney market, above 85%. The Sydney's now had a full month of clearance rates above 85%, and it's had 11 weeks in a row now above 80%, Michael, and that's, in the circumstances of a lockdown. So we're back as strong. The Sydney market is as strong now as it was, or nearly as strong as it was during its record run in March and into April. And we will see more listings coming through in the Sydney market, very strong results. In fact, these are record results for the spring market now, the mid-spring market in Sydney. Melbourne has bounced back remarkably, Michael. Nearly 1,000 auctions in Melbourne on the weekend, Michael. That's the highest number, of course, since lockdown. No surprise that given the doubling of auction listing numbers, that clearance rates ease slightly, but they're still well above 75%. And we will see more properties coming into the market now because we've really just come out of lockdown in Melbourne, all those restrictions on inspections in Melbourne. So that market will be heading back above 80%, I believe, quite soon. And the other smaller capital city markets, Michael, just remarkable results. This is very much still a seller's market. Prices are rising. I believe prices growth will rise again over October. September was actually quite steady for prices growth. Prices growth is tracking at around about 2% a month at the moment in most capitals, exception Perth. And I think it'll be around about that over October again, maybe even a little higher. Remembering our peaks in Sydney anyway got up close to 3% per month. So it is about those coming back into the market that were restricted during lockdown. And affordability, even though it has certainly declined, Michael, and affordability is now just above average levels, it still has some way to run before it gets back to the sort of levels that we had when the cycle does start to flatten.
So we've got only a few weeks till the end of the year. It'll be really interesting to see if the markets actually close up over Christmas like they used to traditionally, or whether there's going to be a catch up and buyers, sellers and estate agents are still going to work. But there's no doubt that the year's going to finish off strongly, Andrew. So I look forward to catching up with you again next week to discuss what's happening in the world of property.
Yes, Michael, and as usual, interesting times.